You probably never saw this coming. Most people didn't. But right now, a financial shockwave is moving silently through the global system, and it has your retirement savings directly in its path. Japan's 40-year government bond market just imploded. Yields detonated from 3.6% to north of 4% inside a single trading session, the most violent one-day move since 1999. And here is the number that should stop you cold. It took just $280 million in bond sales to unleash $41 billion in total value destruction. Less than $300 million moved the market. Now ask yourself, what happens when someone unloads billions? By the time Wall Street switched on its screens, the damage was already bleeding across borders. U.S. Treasury yields lurched upward. The 10-year climbed to 4.3%. The 30-year charged toward 5%, the psychological line every fixed-income trader dreads. Equities wobbled. Credit conditions tightened. Mortgage costs spiked. And here we are, February 16th, exactly 4 weeks out from the next Federal Reserve policy meeting on March 17th, watching bond markets sell off again. Yields are surging. The bedrock of the entire global financial architecture is developing cracks that nobody in mainstream media wants to talk about plainly. This is not a stock story. This is not a cryptocurrency story. This is a bond story. The quiet, unspectacular, supposedly risk-free asset class your grandparents kept in their portfolios. Except risk-free is a fiction now, and when the bond market fractures, the damage doesn't stop there. Stocks fall. Property collapses. The broader economy buckles. Everything goes down together. So today, we are going to walk through exactly what is happening in bond markets at this moment, why a crisis in Tokyo has direct consequences for your financial life, what is pushing yields higher ahead of the Fed's March meeting, and what all of this means for your wealth. Because if you think the equity market pullback is the headline story right now, you are watching the wrong screen. The bond market is where the real catastrophe is being assembled. Let us start with what unfolded in Tokyo on January 20th, 2026. A Monday morning, Japanese markets open and the warning signs appear immediately. Government bonds are not just sliding, they are being thrown overboard. The 40-year Japanese government bond, the JGB, watches its yield rocket from 3.6% to 4.0%, then 4.1%, then 4.24%, a yield explosion of nearly 70 basis points in one session. The 30-year bond performed even more destructively. Yields leaped 25 to 30 basis points, the largest single-session move since 1999. Now, if you don't track bond markets daily, let me give you the context you need. Equity markets can move 5%, 10%, even 15% in a session, and that is considered normal. But bonds are built differently. Bonds are engineered for stability. A 25 basis point daily move in bonds is a crisis event. 70 basis points is a full-scale catastrophe. And the most chilling detail, according to detailed market analysis, just $170 million in 30-year bond sales combined with $110 million in 40-year sales triggered this entire collapse. A grand total of $280 million moved the needle, and the total destruction of value across Japan's yield curve, $41 billion. That gives you a leveraged destruction ratio of 1 to 146. $1 sold obliterated $146 in market value. The reason is simple and deeply alarming. The market had no buyers. When sellers showed up, there was nobody on the other side of the trade. Prices cratered, yields exploded. This is what a broken market looks like. So what lit the fuse? Two forces. One political, one mathematical. On January 19th, Japanese Prime Minister Sai Takaichi made an announcement. Snap elections were being called for February 8th, and to court voters, she unveiled her economic agenda, labeled Sananomics by the press. The centerpiece was a 21.3 trillion yen stimulus plan, roughly $135 billion US in infrastructure investment, tax reductions, and government handouts. But she added one more ingredient. She proposed suspending Japan's 8% consumption tax on food products for 2 full years. That consumption tax generates approximately $31.5 billion annually. So Taichi was simultaneously proposing to spend $135 billion more and sacrifice $63 billion in tax revenue across 2 years. The total fiscal damage, nearly $200 billion with zero funding mechanism. For most developed economies, this would be irresponsible but survivable. Japan is not most economies. Japan carries the heaviest debt burden of any developed nation on the planet, debt to GDP exceeding 260%. The United States sits at 125%, the United Kingdom at 115%, France at 101%. Japan is not approaching a debt problem. Japan is submerged in one, and Taiichi just proposed pouring fuel directly onto the flames. Bond investors didn't wait around. They sold. If Japan is going to borrow and spend without restraint, more bonds will flood the system. And if bond supply explodes, yields must rise to attract buyers who don't currently exist. But the story goes deeper. This is fundamentally a Bank of Japan story. For decades, the Bank of Japan wrestled with an impossible problem, deflation, so they deployed every tool: negative interest rates, unlimited bond purchases, money printing on an industrial scale, quantitative easing pushed to its absolute limits, and for years, none of it worked. Inflation stayed anchored near zero. Then COVID struck, supply chains seized up globally, energy prices detonated, and suddenly, inflation came knocking on Japan's door. Japan's core inflation reached 2.9%. For an economy conditioned to zero, that reading was a genuine shock to the system. And now, the Bank of Japan confronts a completely different problem. They must fight inflation, so they lifted rates from 0.1% to a positive 0.75%, the highest policy rate Japan has seen since September 1995. More than 30 years. But here is the trap. The BOJ wants to continue raising rates to suppress inflation. But every rate hike sends bond yields higher still. The government's interest payments balloon. The debt spiral gains momentum. Yet if they abandon the rate hiking path, inflation could entrench itself. Every option leads somewhere painful. Bond investors can see this trap clearly. They understand that the Bank of Japan can no longer rescue them by buying bonds indefinitely. So they are exiting positions at speed. All right, Japan's bond market has blown up. Why does this land in your lap? Because Japan is the single largest creditor nation in the world, and Japan holds over $1.2 trillion in United States Treasury securities. For decades, Japan has been a quiet and consistent underwriter of American government borrowing, purchasing U.S. bonds and keeping American interest rates suppressed at artificially comfortable levels. But now, Japanese bond yields are rising, and here is the investor logic that changes everything. If a Japanese fund manager can earn 4% on a JGB at home, why would they purchase U.S. Treasuries yielding 4.3% and absorb currency risk on top of that? They wouldn't. So they're not. They are repatriating capital, pulling it back to Japan. This process has been named the Great Repatriation, and it has barely started. On January 20th, the same day Tokyo was burning, U.S. Treasury yields jumped. The 10-year surged nearly 6 basis points to 4.3%. The 30-year pressed up to 4.93%. Why? Because Japanese investors are selling, or at minimum because markets are factoring in the mounting probability that they will sell in large quantities, and Japan is not the only actor in this. China has been methodically reducing its treasury exposure for months, now down to $682 billion, the lowest level since 2008. Foreign demand for American debt is retreating, and that creates a profound problem. Because in fiscal year 2025, $9.2 trillion in U.S. government debt matured. $9.2 trillion, 25% of the entire national debt stack, all rolled over, all refinanced, all repriced at today's higher rates. The interest bill on American national debt has crossed $1 trillion per year, more than the entire defense budget, more than Medicare, just interest payments. And every time yields push higher, that figure escalates. But government debt is only one layer of this crisis. Corporate America is equally exposed. According to S&P Global Analysis, corporate debt maturities are forecast to surge from $2 trillion in 2024 to nearly $3 trillion by 2026. $3 trillion in corporate obligations needing to be refinanced or repaid over the next 12 months. And here is the brutal arithmetic. This debt was originally issued during the pandemic years when rates hovered near zero. Companies locked in borrowing costs of 3%, 4%. Today, those same companies must refinance at 7%, 8%, double the cost. Many can absorb it. Apple, Microsoft, the balance sheet fortresses will navigate this without difficulty. But smaller operators, heavily leveraged companies, they are facing a wall they cannot climb. Commercial real estate is already a disaster zone. Over $1.5 trillion in commercial real estate loans are maturing through 2026. Office buildings standing largely vacant after remote work restructured where people spend their professional lives. Asset values have imploded, but the debt attached to those assets hasn't moved. Landlords cannot refinance because the collateral is worth a fraction of what was borrowed against it. So defaults accumulate. Banks absorb losses. The cycle feeds itself. Then there is the extend and pretend dynamic. Lenders have been rolling loan maturities forward, delaying foreclosures, buying time and hoping that valuations would eventually recover. But those extensions are expiring. The deadlines are arriving. The moment of reckoning has come. So you have sovereign debt, corporate debt, and real estate debt, all simultaneously pressing against a maturity wall, all competing for the same finite pool of buyers, and those buyers are demanding more yield. So yields climb, and the spiral deepens. Why is all of this erupting specifically now? Why are yields surging in February 2026, directly ahead of a Fed meeting? 5 reasons. First, Japan shattered the illusion of safety. For a generation, bond markets were the boring end of finance. Japan proved in one session that era is finished. 70 basis points in a day. $41 billion dissolved on minimal volume. Fixed income traders everywhere now understand this market is fragile, illiquid, and capable of violent moves without warning. Second, inflation has not surrendered. U.S. core inflation remains at 3%, still above the Fed's 2% mandate. Wages are growing at 3.7% annually. The market is slowly repricing the possibility that rates remain higher for considerably longer. Third, fiscal dominance. Governments across the developed world are spending without restraint. The U.S., Japan, and Europe are all running deficits at peacetime records. Debt mountains are growing, and investors are losing patience. They are requiring higher yields as compensation for fiscal recklessness. This is bond vigilantism. The vigilantes have returned. Fourth, foreign buyers have withdrawn. China is selling. Japan is repatriating. The traditional anchor buyers of U.S. debt are stepping back. What remains is domestic demand, pension funds, commercial banks, retail investors. But these pools have finite capacity. So yields must rise until supply and demand reach equilibrium. Fifth, the Fed's rescue capacity is gone. In previous cycles, when bond markets showed stress, the Fed could intervene. Buy bonds, print money, suppress yields. That option is off the table. Inflation is still running above target. If the Fed monetizes debt today, inflation comes roaring back. So the Fed sits on its hands. Hoping is not a policy framework. It is February 16, 2026, exactly 30 days until the Federal Reserve convenes on March 17th and 18th. Potentially the most consequential meeting in years. Jerome Powell's term as Fed chair concludes in May. Meanwhile, President Trump has been delivering public attacks on Powell for months. A Department of Justice investigation is in motion, and Trump has been sending signals that a replacement is already chosen. The announcement could land at any moment, possibly during the meeting itself. Maximum disruption. At the January meeting, the Fed held rates at 3.5% to 3.75%. No adjustment, just patience. But 2 Fed governors dissented. Both wanted rate cuts. The fault lines are visible. Political pressure from above, internal disagreement within, bond markets cracking below, and the maturity wall approaching from the front. What does the Fed do next? 3 choices, all of them ugly. Option 1, cut rates. A rate cut would signal distress. It might provide temporary relief, lower yields, ease some refinancing pressure, but it risks reawakening inflation. The Fed just acknowledged inflation remains above target. How do they justify cuts? Beyond the economics, a cut hands Trump a political victory. Fed independence becomes a talking point rather than a principle. Option 2, Hold rates steady. This is the most probable outcome. Stay at 3.5% to 3.75%. Communicate patience. But holding rates accomplishes nothing if bond markets continue their deterioration. A Fed hold does not stop yields from rising. It does not slow the maturity wall. It does not reduce refinancing costs. Holding rates is managing the optics while the structural problems compound. Option 3, hike rates, the nuclear scenario. This would accelerate the bond market sell-off, send yields into genuinely dangerous territory, but might restore the Fed's credibility. In practice, this is not a real option, not with a presidential election cycle in motion, not with Powell departing. The Fed will hold and hope. But the runway for hope is shortening. Let me show you how the deterioration unfolds if this trajectory continues. $3 trillion in corporate debt is approaching maturity. Companies need refinancing, but the window prices them at 7% to 8%. Many cannot service debt at those levels, so they attempt to sell assets. But when every leveraged company moves simultaneously to raise cash, asset prices collapse in unison. Buyers evaporate. Then someone defaults. Not Apple, not Microsoft, but a recognizable name, a major retailer, an airline, a commercial real estate trust. The filing hits the wires. Creditors take immediate losses. Credit spreads blow out. New lending contracts. Other companies living on the margin get pushed across the line. The cascade accelerates. Banks begin disclosing write-downs. Regional banks especially, whose balance sheets carry heavy concentrations of commercial real estate exposure. This is not hypothetical. In 2023, Silicon Valley Bank, Signature Bank, and First Republic all collapsed under the weight of bond-related losses. A repeat is possible, this time potentially larger in scale. And if bank failures multiply, credit markets seize. Businesses cannot access operating capital, payrolls go unmet, workforce reductions begin, the economy crosses the recessionary threshold, equity markets crash, your retirement account gets cut. This is not catastrophizing. This is debt arithmetic. Hard, cold, relentless debt arithmetic. And ordinary households are caught in this too. The 30-year fixed mortgage rate is directly tethered to the 10-year Treasury yield. When Treasury yields spike, mortgage rates follow immediately. Today's average 30-year mortgage sits around 7%. Many borrowers are seeing 7.5% or 8%. If you purchased a home in 2020 or 2021 and locked in a 3% rate, you are insulated for now. But you are also immobile. If your life requires you to relocate, for employment, for family, for anything, your replacement mortgage would carry a rate more than double what you currently pay. So, you stay. You are not frozen by choice but by mathematics. The housing market stalls. Transaction volume collapses. Prices flatten as demand withers. New buyers face monthly payments they cannot manage. Builders stop breaking ground. Construction employment falls. An entire sector accounting for nearly 30% of economic activity grinds toward paralysis, all because bond yields moved. This is not an American phenomenon in isolation. The contagion risk is planetary. The United Kingdom confronted a bond crisis in 2022 when Prime Minister Liz Truss announced unfunded tax cuts. Markets responded by destroying her government. She resigned after 44 days in office. Italy carries 2 trillion euros in sovereign debt. If Italian yields spike sharply, the stability of the entire Eurozone enters question. France, Spain, even Germany, all running meaningful deficits. Emerging market economies are acutely exposed. Nations that denominated their debt in US dollars face automatic cost explosions when American rates climb. Argentina, Turkey, Pakistan, perpetually operating at the edge of crisis. And if multiple sovereign borrowers fracture simultaneously, we are discussing global contagion, capital flight, currency crises, IMF intervention, austerity programs, civil unrest, political destabilization. This is systemic risk, the category of event that can bring down the entire architecture of global finance. Does this sound exaggerated? It happened in 2008. The conditions for a repeat are present today. 3 scenarios. Here is how this resolves. Soft landing, 30% probability. Bond yields find a ceiling around 4.5% on the 10-year and stabilize. The Fed maintains its current posture. The economy decelerates but avoids contraction. Corporate defaults remain contained. Banks manage their exposure. The maturity wall gets scaled through refinancing and asset sales. By late 2026, the acute phase passes. This outcome is achievable. But I assign it only 30% probability because the underlying dynamics are genuinely deteriorating. Too much debt. Insufficient buyer demand. Too many simultaneous pressure points. Hard landing. 50% probability. This is the central scenario. Bond yields push to 5% before leveling off, but the collateral damage is already locked in. Corporate defaults escalate. Regional banks report losses and tighten lending. The Fed is forced into emergency rate cuts, but the response comes too late to prevent contraction. Recession takes hold. Unemployment climbs to 5% or 6%. Equity markets shed 20% to 30% of value. Retirement account balances take a serious hit. The housing market stalls completely. Economic growth vanishes for a year or more. Painful, disruptive, but survivable. The financial system remains intact. By 2027, the recovery process begins. 50% odds, the most probable path. Catastrophic unwind. 20% probability, the nightmare sequence. Yields breach 5%, then 6%. Panic becomes self-reinforcing. Foreign holders liquidate everything simultaneously. The U.S. Treasury struggles to attract sufficient buyers at any price. The Federal Reserve is backed into printing money to monetize government debt. Inflation surges back. Stagflation returns. Corporate defaults arrive in waves. Multiple significant bank failures. Credit markets freeze entirely. Another 2008, or worse. Stock markets lose 40% or more. Unemployment reaches 8%. Recession deepens toward depression-level conditions. Social cohesion strains. Political systems destabilize. Low probability, but not negligible. 1 in 5. That is Russian roulette odds with the global financial system. 5 signals to monitor at the Fed's March meeting. The Fed convenes March 17th and 18th. Here is exactly what to watch. Signal 1. The official statement language. If they characterize inflation risks as having diminished, that is dovish. Rate cuts are moving closer. If they describe risks as remaining elevated, that is hawkish. And if they introduce new language specifically referencing financial stability concerns, that is a red flag. Signal 2. Powell's press conference conduct. Composed, deliberate, measured communication signals confidence. Markets will stabilize on that tone. Defensive posture, evasive answers, visible stress. That is a negative signal. Markets will panic. And if he references bond markets directly and specifically, treat that as a serious alert. Signal 3. The dissent count. January produced 2 dissenting votes in favor of cuts. If that number grows at the March meeting, it signals internal fracturing. Divisions create uncertainty. Markets interpret Fed division as loss of control. Signal 4. The dot plot projections. If those projections shift lower, the signal is dovish. Cuts are being pulled forward. If they hold firm at current levels, the signal is hawkish, higher rates persisting longer. Signal 5. The new Fed chair announcement. Trump may name Powell's successor before, during, or immediately after this meeting. If the nominee signals a preference for lower rates, markets will rally. If the nominee leans hawkish, someone in the mold of Kevin Warsh, prepare for an immediate market sell-off. 4 actions for your money. I am not a registered financial advisor, and nothing here constitutes personalized investment counsel. But here is what sophisticated capital is doing right now. Action 1. Compress your bond duration. Long-duration bonds are absorbing severe losses as yields rise. Short-duration instruments are holding their value far better. Rotating toward shorter maturities reduces your exposure to further yield increases. In the current environment, protecting the principal matters more than maximizing income. Action 2. Accumulate cash reserves. Warren Buffett is sitting on $325 billion in cash. The reason is strategic optionality. Cash allows you to purchase assets from others who are being forced to sell at distressed prices. 6 months to 12 months of living expenses held in a high-yield savings account paying 5% annually is reasonable positioning right now. Action 3. Allocate toward real assets. Bonds are contractual promises documented on paper. When those promises break, you are left with nothing. Real assets function differently. Physical gold, real estate held outright, commodities with industrial utility. These have intrinsic worth that exists independently of institutional promises. Not as your entire portfolio, but 5% to 10% as a hedge against systemic stress makes sense. Action 4. Engineer your psychological preparation. The next 6 months may deliver sustained financial turbulence. Do not allow volatility to trigger emotional decision-making. Construct your response plan in advance. Decide today what you will do if your portfolio declines 10%, 20%, 30%. If you have decades of investment runway ahead, market crashes represent acquisition opportunities. If retirement is approaching within 5 years, shift your posture toward capital preservation. But in either case, do not disengage. This is the central financial narrative of 2026, and it demands your attention. Let me assemble this picture one final time. On January 20th, 2026, Japan's government bond market detonated. Yields exploded. Billions evaporated. And the world witnessed with uncomfortable clarity just how fragile these supposedly safe markets have become. The contagion moved immediately to the United States. Treasury yields jumped. The 10-year reached 4.3%. The 30-year pushed toward 5%. And 1 month later, nothing has been resolved. Yields remain elevated. Bond markets remain on edge. $3 trillion in corporate debt is pressing against its maturity deadline. $9 trillion in government debt was repriced at higher rates last year. The maturity wall is not theoretical. It is arriving on schedule. Japan's capacity to absorb U.S. bonds has been eliminated. China is actively reducing exposure. Foreign demand has left the building. The Fed convenes in 30 days, and their choices are a menu of bad options. Cut rates and sacrifice inflation credibility. Hold rates and watch the stress accumulate. Hike rates and trigger the recession themselves. No exit without cost. Corporate defaults are gathering. Bank balance sheets will absorb losses. Credit conditions will tighten. Recession probability is climbing. And your financial life, your 401k, your property, your savings buffer, sits in the direct path of all of it. This conversation is not about speculative trading strategies. It is not about timing the next crypto rally. It is about the structural foundation that supports every financial asset you own. When bonds deteriorate, they don't take down just one sector. They take down the collateral system, the lending system, the pricing mechanism for everything else. Bonds are the foundation layer, and right now that foundation is showing stress fractures. We are living through a transition of historic proportion. The 4-decade bond bull market is over. Structurally higher interest rates are the new reality. The consequences of accumulated decades of debt are arriving simultaneously. Some people will be destroyed by what is coming. Others will be positioned to acquire generational wealth from the forced selling of those who weren't ready. That divide is determined entirely by preparation. So do this. Watch the Federal Reserve meeting. Monitor bond yields daily. Track corporate default announcements. Diversify your exposures. Hold adequate cash. Shorten your duration. And build the mental framework to act deliberately rather than react emotionally when the next shock arrives. Because the bond market is the most powerful force in global finance, and right now, that force is under severe and escalating stress. The storm may already be inside the harbor. The only remaining question is whether you are prepared for it.